Want to own several good US companies in one click? That's what an ETF can do. An ETF, exchange traded fund, is like a mutual fund you can trade anytime, just like a stock. Instead of buying one stock, you buy a ready-made collection. Tech giants, clean energy leaders, or the entire S&P 500. And you're not limited to the US. Global ETFs like EPOL, Poland, and GREC, Greece, have delivered strong returns. You can even tap commodities through base and precious metal ETFs like Ring and SGDM for gold miners. ETFs give you diversification in one purchase, so if one stock stumbles, others can keep you balanced. Many US ETFs have lower expense ratios than Indian overseas mutual funds, as low as 0.1 to 0.4%. Over 15 years, for example, on a Rs 15 lakh investment, an Indian investor could lose up to Rs 13 lakh more by going through Indian MFs instead of US ETFs. Plus, when RBI limits on overseas investments are hit, investors are starting at a disadvantage, as Indian mutual funds often trade at a premium of 10 to 25%, making direct US ETFs even more cost-effective. And those RBI caps are strict. $7 billion for all overseas mutual funds and just $1 billion for overseas ETFs. That's why many funds have had to stop fresh inflows recently. But with the Liberalized Remittance Scheme, you can directly invest up to $250,000 a year in US ETFs. No caps, no premiums, full access. Here's how to read an ETF. Name, ticker, what it holds, and expense ratio. That's your quick health check. Popular choices: SPY for the S&P 500, QQQ for Nasdaq Tech, SMH for semiconductors. All accessible on Appreciate. For long-term growth with less guesswork, ETFs can be a smarter, simpler, more diversified entry into US markets.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.